Okay, let's dive right into this explainer and demystify the Australian tax system. Today, we're building a really clear step-by-step blueprint of exactly how your final tax bill is calculated. For a lot of people, tax time feels like feeding numbers into some mysterious black box and just crossing your fingers for a good outcome. But honestly, whether you're a seasoned pro negotiating a massive salary package or you're just stepping into your very first full-time gig, understanding the nuts and bolts of your tax return is one of the most empowering financial tools you can possibly have. So we're going to break down the exact flow of how your taxable income is determined. We're removing the guesswork entirely to show you precisely what's happening behind the scenes.
To really wrap our heads around the sheer scale of the system we're decoding, listen to this number. In the 2022-23 financial year, taxation receipts hit roughly $508.4 billion. That is a staggering figure, and it makes up about 92% of total government revenue. So we aren't just talking about some annoying deduction on your fortnightly payslip here. We are talking about the primary economic engine that literally keeps the entire country running day in and day out. It's the financial lifeblood that supports everything a functioning society relies on.
So, where does all that money actually go? Well, the government pumps these massive funds directly back into public goods. The largest chunk by far, about 35%, is dedicated to Social Security and welfare. Health follows that at 17%, and education sits around 7%. It's basically a vast, continuous redistribution engine designed entirely for socioeconomic stability. Understanding your personal tax calculation means understanding your direct contribution to this $500 billion national ecosystem.
Here's our roadmap for this explainer. First, why we pay taxes. Second, the income tax formula. Third, income and deductions explained. Fourth, calculating your tax bill. Fifth, tax offsets versus deductions. And finally, the tax residency factor.
Starting right at the top with Part 1, why we pay taxes and how it funds the system.
Moving right along to Part 2, the income tax formula, or as I like to call it, the master blueprint.
Despite literally thousands of pages of incredibly dense tax legislation, the whole system essentially boils down to this surprisingly straightforward four-step funnel. This is your master blueprint. Understanding this flow is the absolute secret to taking control of your tax return. Step 1, you calculate your gross assessable income. That's everything you've earned that the government has a right to tax. Step 2, you shrink that pile of money by subtracting your allowable deductions. The amount you're left with, that equals your taxable income. Step 3, you apply the government's tax rate specifically to that taxable income, not to your original gross earnings. And finally, Step 4, you reduce that calculated tax bill by applying any eligible tax offsets. If you just memorize this exact sequence, assessable income minus deductions equals taxable income multiplied by rates minus offsets, the system is no longer a mystery. It becomes a highly predictable step-by-step mathematical process.
Which brings us to Part 3, income and deductions explained. Basically our starting point.
So, what goes into the very top of that funnel? That's your assessable income. It's made up of ordinary income, the usual suspects, right? Your salary, your wages, or proceeds from running a business. But it also includes statutory income. This covers specific financial gains captured by the law that you might not consider a standard paycheck, like a capital gain from selling an investment property or a parcel of shares. But here's a crucial detail. Exempt income, things like certain educational scholarships, childcare subsidies, or specific government grants, is strictly excluded. It never even enters the funnel. That means you don't even need to worry about claiming deductions against it.
Now for Step 2, and this is where you get to take back some control. We're talking about deductions. These are incredibly powerful because they shrink your assessable income before the government even decides what tax rate to apply. These are losses or outgoings that the law specifically allows you to subtract. Think of the cost of specialized tools for a tradie, union fees, professional subscriptions, or expenses related to managing an investment portfolio. The golden rule here is that the money must have been spent to help you earn your assessable income. The smaller you can legally make your income pile through these strategic deductions, the less money you are eventually going to be taxed on at the end of the year.
All right, Part 4, calculating your tax bill and actually applying the rates.
Now we take the government's rates and apply them to your newly shrunken taxable income. Australia uses a progressive tax system. For residents, the first $18,200 you earn is completely tax-free. As your income goes up beyond that, you move through progressive brackets. Let's bust a huge, common myth right now. There is this idea that moving into a higher tax bracket means all of your income is suddenly taxed at that new, higher rate, leaving you with less take-home pay. No way!
That is entirely false. You only ever pay the higher rate on the specific dollars that fall strictly within that new tier. For example, if you earn just over $45,000, you only pay the 30-cent rate on the dollars earned above that line. The first $45,000 is still taxed exactly the same as it is for everyone else.
Now, aside from those standard income tax brackets, most residents also pay a 2% Medicare levy to help fund the public health system. Let's look at exactly how this calculation works in practice with a quick example. Say Matthew earns a gross assessable income of $76,000, but he correctly claims $1,000 in allowable work-related deductions. His taxable income is therefore brought down to $75,000. When it comes time to calculate his Medicare levy, it's 2% of his $75,000 taxable income, which equals $1,500. It's not 2% of his raw $76,000 earnings. This perfectly highlights why tracking every single legitimate deduction is so critical. It creates a cascading effect that lowers multiple different tax obligations all at once.
Let's pivot to Part 5, tax offsets versus deductions and the really big difference between them.
Okay, this right here, this is a massive aha moment for a lot of folks because a deduction and an offset are completely different financial mechanisms. A deduction, as we just saw, shrinks the income pool being taxed. If you have a $1,000 deduction, you don't save $1,000 in cash. You simply avoid paying tax on that $1,000 portion of your income. Depending on your bracket, a $1,000 deduction might save you, say, $300 in actual tax. But a tax offset, sometimes called a rebate, happens way down at step 4. It is subtracted directly from the final calculated tax bill you owe the government. A $1,000 offset means your actual tax bill is wiped out by exactly $1,000. Dollar for dollar, offsets are significantly more powerful, and knowing which ones you qualify for is an absolute game changer for your savings.
Finally, Part 6, the tax residency factor, which is a really crucial caveat to all of this.
So this entire blueprint comes with one major caveat that dictates exactly which rules apply to you, your tax residency. And spoiler alert, your tax residency is not always the same as your immigration status or your visa type. If you are considered a foreign resident for tax purposes, the formula shifts dramatically. First off, you're only taxed on income sourced inside Australia, not your global income. Secondly, you do not get that nice $18,200 tax-free starting threshold. You pay tax from the very first dollar you earn here. But on the flip side, you also completely skip the 2% Medicare levy, since as a foreign resident, you typically aren't entitled to utilize those public health benefits anyway.
So how do you actually figure out where you stand? Well, you only need to pass one of 4 specific tests to be considered an Australian resident for tax purposes. These are the resides test, which is based on ordinary legal concepts, the domicile test, the 183-day physical presence test, or the superannuation test for government employees working overseas. It's not just about counting the days you've been in the country. It's ultimately a question of fact and degree. The tax office is looking closely at your long-term intentions, your family and business ties, your living arrangements, and where your actual home base is truly established.
Wow, okay, we've gone from a $508 billion macroeconomy all the way down to the step-by-step mechanics of your individual tax return. So, as you organize your own finances this year, I'm going to leave you with this to chew on. Have you correctly identified your residency status? And, more importantly, are you fully leveraging the absolutely crucial difference between a deduction at the top of the funnel and an offset at the bottom? Understanding this simple 4-step blueprint is the ultimate key to taking control of your financial health. It ensures you pay exactly what you owe to support the system and not a single cent more.